This visualization maps millions of dollars in capital flowing through the American political system. This money has a specific target: disconnecting legacy regulatory oversight and building a parallel architecture for the U.S. financial system. For years, the cryptocurrency industry spent its resources on defensive legal battles against federal enforcement agencies. That strategy has pivoted. The industry is now executing a targeted legislative strike designed to permanently rewrite the boundaries of agency jurisdiction. The mechanism funding this rewrite operates as a stealth campaign. Massive political action committees, like Fairshake, pour millions into state primaries and frequently claim total sweeps for their backed candidates. Yet the candidates themselves rarely mention digital asset policy on the trail. The campaign messaging deliberately removes terms like blockchain or crypto from the airwaves. Instead, the industry funds traditional political ads to install compliant lawmakers without ever engaging on the specifics of the technology. The money pays for generic political theater. PACs fund heavy ad buys tying local candidates to popular national figures in key districts, ensuring victory through established partisan machinery. This capital has an explicit agenda. It is funding 3 foundational laws designed to formalize digital assets within the American financial system. By redefining agency oversight, formalizing private stablecoins, and unlocking institutional custody, the lobby is executing a structural override of U.S. financial law. For years, a bitter jurisdictional battle has defined the industry. The Securities and Exchange Commission treats most cryptocurrencies as unregistered securities, subjecting them to strict financial enforcement. The primary objective of the crypto lobby's legislative agenda is the Digital Asset Market Clarity Act, or the Clarity Act. The central function of the Clarity Act is to legally strip the SEC of authority over any blockchain network deemed functional and decentralized. This diagram shows the mathematical test established by the bill to determine if a project qualifies as decentralized. Under this framework, a network passes the test if no single entity controls more than 20% of the voting power or token supply. Once a network passes that specific threshold, its native tokens are reclassified strictly as digital commodities. This bill passed the House with a strong bipartisan majority, providing a clear return on investment for the PAC's targeted lobbying efforts. Reclassifying these assets hands exclusive oversight to the Commodity Futures Trading Commission, an agency the industry views as more rule-bound and cooperative. The Clarity Act is not a minor regulatory adjustment. It is a mathematical tool designed to move digital assets under a different regulatory regime. The second pillar targets the transactional plumbing of the crypto economy, stablecoins, which move billions of dollars globally every day. The industry is pushing for the Guiding and Establishing National Innovation for U.S. Stablecoins Act, or the Genius Act. For stablecoin issuers, the bill provides a path to bypass a complex web of state-by-state money transmitter licenses in favor of a single federal framework. This visualization shows the consumer protection mandate within the bill. All permitted stablecoins must be backed one-to-one by ultra-liquid assets, including physical U.S. dollars and short-term treasuries. To appease traditional banking lobbyists who fear these assets could trigger bank runs, the legislation prohibits issuers from paying out interest directly to retail holders. While the Genius Act builds the framework, much of the lobbying effort is defensive, stopping the Federal Reserve from creating its own digital currency. The industry views a digital dollar issued directly by the Fed as an existential threat to private stablecoins and decentralized finance. In response, lobbyists successfully inserted statutory language into financial bills that strictly prohibits federal agencies from establishing, issuing, or promoting a retail CBDC to individuals. By combining the Genius Act with the CBDC ban, the lobby secures federal legitimacy for stablecoins while legally eliminating their government-backed competitor. The final pillar removes the roadblock that stalled institutional crypto growth for years, the SEC accounting rule known as SAB 121. This T account shows the core problem. SAB 121 required any publicly traded bank holding digital assets for customers to list those assets as a liability on their own balance sheet. Because banks must hold matching cash reserves against their liabilities, offering crypto custody at scale was economically impossible for Wall Street firms. Following intense pressure, the SEC officially rescinded the rule in January 2025, replacing it with guidance under SAB 122. This reset triggered a cascade. The Office of the Comptroller of the Currency affirmed that national trust banks can engage in digital asset safekeeping. Since then, the OCC has granted or finalized at least 9 national trust charters to institutional players like Fidelity, Paxos, and Circle. These new crypto banks focus on 4 services. First is institutional qualified custody, utilizing multi-tier cold storage to ensure customer assets are bankruptcy remote and segregated from the bank's own funds. Second is riskless principal trading. This allows banks to match buy and sell orders directly out of custody without taking on market volatility itself. Third is institutional blockchain staking. This allows pension funds and corporations to earn network-level yields through federally audited validation nodes. The fourth service is real-time trade settlement. These charters enable platforms to bypass legacy banking delays, allowing 24/7 settlement of tokenized real-world assets. The shift from SAB 121 to OCC charters engineered a parallel architecture, integrating Wall Street into digital assets without triggering commercial banking risks. Pulling back, the newly engineered map of U.S. financial regulation shows a bifurcated system. Decentralized assets route to the CFTC. Stablecoins operate as private monopolies. Institutional capital enters OCC trust vaults. This rapid regulatory shift has sparked a sharp counterpush from lawmakers like Senator Elizabeth Warren. Critics and groups like the Bank Policy Institute argue that these OCC trust charters enable a form of regulatory arbitrage. The core argument is that these institutions are evading the strict capital requirements and FDIC insurance obligations that apply to traditional commercial banks. This impending legal battle brings the story back to the central paradox of current crypto politics. The most significant structural rewrite of U.S. financial architecture in a generation is being quietly executed by political machinery designed to never say the word crypto out loud.